Markets cheer as Washington nears a deal. What the shutdown breakthrough means for investors. This is your Pie Uncut investing editorial. And today we're unpacking a headline that sent markets rallying. Stocks rise as government shutdown deal advances. After weeks of gridlock and economic anxiety, investors finally got what they were waiting for. A glimmer of political sanity. 1. The rally that Washington built. On Monday morning, Wall Street opened to a surge of green screens. The Dow Jones Industrial Average jumped 334 points, the S&P 500 rose 1.2%, and the Nasdaq led the charge, soaring 1.88%. And at the heart of the rally, the big tech titans. Nvidia popped 3.5%, Alphabet climbed nearly 2%, Tesla rose 2.1%, and Palantir spiked an impressive 4.7%. Even Meta and Apple joined in, helping the Dow close its best opening in weeks. The spark behind it all? A Senate breakthrough. Late Sunday, 8 Senate Democrats broke ranks to side with Republicans on a procedural vote that advances a deal to end the longest government shutdown in U.S. history. If passed, the legislation will fund most federal agencies through January, putting hundreds of thousands of furloughed workers back on the job and restoring key public services. For markets, that single move flipped sentiment overnight. 2. Relief across sectors, not just tech. The relief rally wasn't just a tech story. Airline stocks that had been hammered by airport disruptions suddenly took flight. American Airlines, United, and Delta each rose around 2%, recovering some of their multi-week losses. Over the weekend, more than 7,700 flights were delayed and 2,300 canceled, as nearly 40% of air traffic controllers skipped work due to missed paychecks. With the shutdown's end in sight, investors see a return to normal, and less turbulence ahead for the travel sector. Financials also benefited. Goldman Sachs gained 2.3%, JP Morgan Chase added 1.5%, and Cisco saw a nearly 2% lift, signaling confidence that liquidity, spending, and lending activity will stabilize once federal paychecks resume. 3. A nation on edge, the sentiment story. The backdrop to this rally has been consumer pessimism at near-record lows. According to the University of Michigan's Consumer Sentiment Survey, worries about the shutdowns dragging on have been weighing heavily on households. The Conference Board reported similar findings. Americans repeatedly cited the shutdown as their top concern this month, and for good reason. Every week of government inactivity shaved billions off GDP, disrupted federal loans and permits, and froze spending in defense and infrastructure projects. For investors, the fear wasn't just lost output. It was the psychological blow of a dysfunctional government eroding confidence. So Monday's Senate progress isn't just a procedural win. It's an emotional reset for markets that were starting to price in political chaos. 4. The Tesla subplot, when bad news becomes good news. Amid all this, Tesla grabbed headlines for a different reason. Shares rose even after Siddhant Awasthi, head of the Cybertruck division, announced his resignation. Now that might sound bearish. After all, the Cybertruck has had a rocky road. Over a dozen recalls and only 63,000 units sold since launch, far below Elon Musk's 250,000 a year projection. But Tesla stock moved higher because, paradoxically, investors were relieved. A leadership shakeup suggested accountability, cost discipline, and potentially a pivot away from one of Tesla's most controversial products. That's the fascinating part of market psychology. Bad operational news can turn bullish if it signals a new chapter of focus and realism. 5. Why the shutdown deal matters for investors. So why did Wall Street breathe such a collective sigh of relief? Because shutdowns ripple far beyond Washington. They hit consumer spending, delay government contracts, and freeze key data releases that traders rely on, like inflation reports and job numbers. And in an economy where sentiment drives spending, uncertainty is poison. Ending the shutdown restores predictability, which is oxygen for both investors and corporations. It means federal paychecks resume, supporting local economies. Government contractors resume work, improving earnings visibility. Business leaders can plan again, not just react. For earnings season, this stability could be the missing piece that turns cautious guidance into growth forecasts. 6. The bigger picture. Politics meets portfolio. This rally also reveals how tightly politics and markets are intertwined in 2025. We're in an election shadow. Investors have been navigating mixed signals. Tax policy uncertainty, the specter of tariffs and spending cuts, and a Congress that's shown more brinkmanship than leadership. So when even a small bipartisan gesture emerges, Wall Street doesn't just react, it rejoices. Still, this doesn't erase the structural risks. Funding the government through January is just a temporary patch, not a permanent fix. Markets could face another shutdown early next year if Congress fails to find a long-term solution. For portfolio managers, that means one word: volatility. 7. Sector by sector, where the money might move. Let's break it down for investors looking beyond the headline rally. Tech. Nvidia remains the market's emotional anchor. Its 3.5% jump reflects not just AI optimism, but relief that macro headwinds might ease. Expect continued momentum if Washington avoids another fiscal cliff. Financials. Banks love stability. With government contracts and spending back online, expect credit activity to tick upward. Dividend investors might see a steadier Q4 for JP Morgan Chase, Citi, and regional banks. Travel and airlines. A short-term rebound play. Once the FAA and TSA are fully staffed, airline delays should normalize, but long-term gains will depend on oil prices and consumer travel budgets. Defense and infrastructure. The hidden winners. Many contracts were frozen during the shutdown. Firms like Lockheed, Raytheon, and Caterpillar could see backlogged projects accelerate post-resolution. 8. Investor takeaway. Relief rally or reset rally? Here's the question every investor should ask. Is this just a relief rally or the start of a sustained bull move? Right now, it's relief. Markets are reacting to the removal of a negative, not the creation of a new positive. The Fed hasn't shifted policy, inflation remains sticky, earnings growth is uneven, but the return of political stability adds a crucial foundation, confidence, that could fuel year-end positioning. In essence, the market just got permission to breathe again. 9. The road ahead. If you zoom out, this moment offers a deeper lesson. In modern investing, sentiment moves faster than fundamentals. The mere signal of cooperation in Washington added hundreds of billions in market value overnight, not because profits changed, but because the mood did. That's the power and the peril of this market. When confidence is fragile, volatility is a feature, not a bug. For long-term investors, the right play may be to stay diversified, stay disciplined, and resist the noise. The U.S. economy remains resilient. Consumer spending is slowing but not collapsing, corporate balance sheets are solid, and innovation, especially in AI and semiconductors, continues to drive capital. The political drama will ebb and flow, but innovation, from Nvidia's chips to Palantir's data platforms, doesn't take a recess. Closing thoughts. Today's rally isn't just about numbers on a ticker. It's about faith being momentarily restored. Faith that the system, however messy, still works. Investors love growth, but they love stability even more. And for now, Washington's truths, however temporary, is enough to keep the bull alive. This has been your Pie Uncut Investing editorial, analyzing markets not just by the charts, but by the choices that shape them. Until next time, stay informed, stay invested, and remember, even in the chaos of Washington, opportunity never shuts down.